All right, welcome back to part two of our discussion about funds and trusts. And I know that some of this is a little bit confusing. I know there was a lot of material in the first part of this. Again, I'll go through my standard disclaimer that we're this is meant for as an introductory for basic novice. If you really want to know the deep dive and you want to know the more deep dive details, you got to look at other sources. The book After the Trade is Made is a great source. Everything we show here is information publicly available on Investopedia or other public sources. And I'm not making any trading advice here. Nothing should be taken here as trading advice. So, I mentioned it earlier before in the previous video, I talked about the NAV. And so this comes out with how do you price a fund, right? So we talked about how mutual funds get priced at the end of the day as a NAV, and ETFs trade on an exchange. So therefore they're priced throughout the day as the price on the exchange changes. But the NAV is a little bit of a different animal. So mutual fund price per share or exchange traded funds per share value. In both cases, the per share dollar amount of the fund is calculated by dividing the total value of the securities in the portfolio less than the liability by the number of shares outstanding. So if you have a fund that has 10 different stocks and 10 different bonds, if you take the value at the end of the day when the markets close, what they do is they look at the price of those stocks, the price of those bonds, and the price of any other assets. Whatever the price at the close of the market day is for the assets that are held in that fund, they calculate amount divided by the number of how many shares held and any liabilities. And so if the fund has $1 million worth of assets, if you take up the value of all the stocks and all the bonds and assets that the fund has, minus any liabilities, and the fund has $1 million worth of assets, and the fund has, I'll make this up, 100,000 shareholders, then the NAV price would be $10 a share, right? 100,000 shares, $1 million in assets and liabilities over shares outstanding is the NAV price, which would be $10. Now, the NAV is computed once a day, and it's computed at the end of the day. So this is what happens. What happens is, at the end of the day, the exchanges close, the markets close, the exchanges all report the closing price. What was the closing price of the last trade of all of those stocks, bonds, and other assets? And then they report those prices of the closing prices to the mutual fund companies. And then the mutual fund companies calculate what their NAV was. All mutual funds buy and sell orders are processed at the NAV of the trade on the trade date. However, investors wait until the following day to get the trade price. So this is what I was saying earlier. If at 10 o'clock in the morning, I put in an order to buy $10,000 worth of a mutual fund, that order isn't processed by the mutual fund company until the end of the day when they calculate their NAV. So I don't know what my price was per share until the next day when my order is processed. Same thing with us sells. That's just how mutual funds work. Mutual funds pay out virtually all their income in capital gains. As a result, changes in the NAV are not the best gauge of mutual fund performance, which is best measured as an annual total return. That's just a guideline, right? Because all money that the mutual fund makes, they pay out. All the profits that they make out in the mutual fund, they're going to pay out. to the shareholders. I guess there are different ways and different philosophies on how to gauge the performance of mutual funds. But I think this rule of thumb, which says the best measure is the annual total return, is probably a reasonable thing to consider. But again, you should speak to your investment advisor and take their advice. We talked earlier about the term yield. And what does yield mean? So mutual fund yields are an annual percentage measure of income, dividends and interest earned by the fund's portfolio, net of the fund's expenses. So here's the example. You have a mutual fund's investment of $100,000. So the investor, maybe they're a retiree living in Arizona, and they put $100,000 investment into the fund. This produces dividends and interest income of $11,000. The fund expenses are $1,000. So the yield would be 10% or 0.100. Right? So if you go online, you'll see, or you go online, you go to the back of the Wall Street Journal, you go look at the newspaper, you go look, actually everybody's gonna do everything online today, and you look at what's the yield. That's the number you really want to look at. What's the yield of a particular mutual fund? What's the yield they're promised? What's the yield that they're estimating? And that's how that yield would be calculated. In addition, the SEC yield is an indicator of the percentage of yield on the fund based on a 30-day periodic rather than annual. So yes, you can look at the yield annually, or you can look at it 30 days. And I would say the best thing to deal with here is consult your investment advisor and do your research. So that ends my conversation on funds and trusts. Again, if you have any questions, please send me an email and I'll do my best to respond if I can. Thank you very much.